Mortgages can be scary for a first-time home buyer, and we've had a lot of people that would come in and you know, you can obviously see they're nervous when they sit down. It's the biggest expense that you're going to have most likely, you know, over your lifetime. So we sit down with our customers to try to make them feel more comfortable. We go over the whole process, what the payments will be, and just different things that arise throughout the life of the loan. So we try to make the customer aware of all the scenarios that may come across, and just try to make them feel as comfortable as possible. The 15 versus 30 is not an always easy decision on which route to go. That's what State Street Bank is here for, is to try to make that decision a little bit easier and to help the customer figure that out. A 15-year is going to have a little bit higher of a payment, but you're going to build equity in your home quicker. You'll get a lower interest rate on the loan typically. It also, you know, allows you to put more against principal each month versus interest because of the higher payment, which in turn then will save you a substantial amount on interest expense over the life of the loan. You will want to be careful with the 15-year. You're going to look at your whole financial stability and see whether or not, you know, that payment is going to be a little bit too much for you or not. You need to take into consideration your taxes and insurance as well, and see your other bills out there. You want to give yourself flexibility if you're worried about that payment. The 30-year would be a good option for you to do that. The 30-year mortgage, you have the flexibility of a lower payment, but it is going to cost you a little bit more over the life of the loan because you're stretching it out over a longer period of time. The interest rate is going to be a little bit higher, but with the longer amortization, that payment will be lower. So it gives you the flexibility of maybe purchasing a little bit more home, but also keeping your payment affordable because of that longer amortization period. But you do have the option of always prepaying, paying extra on the loan on a month-to-month basis. So that can also help reduce that interest expense over the life of the loan.